thing I've been advising companies to do is hire external advisors when they're thinking about
Mm.
their capital raising and also just their capital structure in general. Because oftentimes a startup will go to their equity VCs and let them kind of dictate the fundraising and the capital structure. And that doesn't really make any sense because there's alignment, but it's not as good as people think. And so you really, as a founder, in my opinion, should not be relying on your lead VCs to tell you what to do because they are not always going to do what's best for you. They are going to do what's best for them. And sometimes there's alignment there, but oftentimes that alignment breaks down. And a lot of founders don't realize that. So that's one thing VCs don't like me to say that because they want to be the only voice in the room, but you're not making good decisions if you're a founder and you're not going to external, counsel essentially when
Sure.
you're making fundraising decisions.
Sure. Yeah. I mean, we've guided similarly our founders to find external counsel. I think it's also they need to be empowered. And also at the end of the day, these are, I mean, they're CEOs and they should know the business in and out and all their different options. So agree, empowering them to be smart about their capital and investments. 100%. Yes.
One of the things I've done over the last several years is really just teach people about venture debt where I'm not trying to sell them anything. I mean, a couple of years ago, we didn't even have capital to deploy, right? And
Yeah.
so clearly I was just there to teach and build credibility. But even now, when we do have capital to deploy,
Mhm.
I still think that the right approach for us, at least, is to start by being a trusted source of information that's not really making an ask. I mean, I don't really care, quite frankly, if any company wants to borrow money from ARI. I literally don't care because there's 1,000 companies out there that we could lend to that are high quality, and I'm not really interested in lending to just one that I really love. I want to lend to a diverse spectrum of companies that meet our investment criteria. And it's very different as a lender than it
Mhm.
is as an equity investor in the sense that if you miss liquid death, if you're an equity investor and you missed out on that, shoot, you missed out on one of the $3 billion exits that LA had in ever, right? And meanwhile, as a lender, though, I wouldn't care if I missed out on liquid death because I'm really playing mainly for the interest. So all I want is companies that are not going to default, that are going to be good, solid companies, pay me back, pay the loan down, and hopefully do really well because we do, of course, have some equity upside through equity warrants typically, but that's not the main driver of our returns. So I try to explain this to folks that, especially LPs that don't really understand how this works, and they conflate venture debt risk with venture equity risk, and they're completely uncorrelated, really.
Mhm.
And they'll say, well, how do you source that like one hot deal? I would never want to do the hot deal as a lender because that means you're going to get the worst terms as a lender. Because if you've got a bunch of term sheets you're competing with, it
Mhm.
means you're going to charge a lower interest rate. The structure is going to be looser and more in favor of the borrower, putting you as the lender at more risk, right? And so a lot of folks don't get that. And so I try to explain to them that what we want to do, not just ARI, but I think any good lender, is hit a lot of singles and doubles.
Yep.
We don't want to strike out. And when we do strike out occasionally, which will happen, there's
Mhm.
going to still be some winners in there where we've got the equity upside that more than counterbalance any losses, right? So,
Mhm.
um, but going back to trends in the market and talking about founders and what they need to do.
Sure.
So you talked about some of the things you look for in good founders. What are some red flags where you want to run for the hills when you see them?
Oh, I think there are certain, I don't know if it's red flags or running for the hills. It's just there are certain businesses that we don't know. Like we are not deep tech investors. And so we get a lot of inbound. And so oftentimes when we see these deals, we're also name science. So oftentimes we'll get some life sciences and healthcare deals. That's not us, right? We're not a biotech firm. That said, personalities, I think, are also again going back to what we look for. Are people open? I think there's, a psychological connection between us and our founders of, hey, we're doing this and we're doing this together. And so I think if there's a break there, and that could be with anything, right? That's not necessarily maybe unique to us, but I think in any business, right, you want to make sure that we're all fully aligned and moving forward. And then some of the others, I think when we look at businesses, again, going back to your point of looking at the cap table, is there anything that stands out, right? Are there, maybe it's a recap, and maybe those are things that we, as we're launching a business, is that something that we really want to move forward on? Are there any legal ramifications for us that we need to be aware of? I think there's, a handful of legal, regulatory, finance. We're working with these businesses super early, so oftentimes there's little to no names on the cap table. But generally, I'd say, at the very earliest, it's really a cultural fit for us.
Question I often get is, how do you source investments? And I
Mhm.
think that's especially important for earlier stage equity investors. It's not really that relevant a question for a venture lender, actually, because the universe is predefined. Because if we're lending to series A, B, and C companies,
Yeah.
they're already out there. It's
Yeah.
pretty obvious. You log into PitchBook or Crunchbase or the equivalent, and they're all there. And then you just decide, okay, of that, five of those 5,000 deals, which
Mhm.
are the 10 that you want to invest in this year. So
Mhm.
for a lender, it's easy in my view. And so that question about sourcing comes from a place of misunderstanding. When they ask me that, when they ask you that, I think it's a really relevant question, because when you're that early, like, how do you find a liquid death? How do you find a Dollar Shave Club? And then when you do find it, are there other people that are trying to get in and box you out? And how do you deal with that?
Good question. I think when we think about sourcing, a big portion of our deals come through referrals. And that's really because they know us. They know what we're known for. We've been around since 2011. So again, are we looking for CPG companies? Are we looking at a mobile company? Are we looking for a marketplace? And is there a D2C component or a B2B to C component to it? Um, so I think a third of them do come through these referrals. A third of them do come through universities. And so we're in LA, right? And so we have really close connections with USC, with UCLA, Caltech, a lot of the engineering hubs. I mean, we have Pepperdine as well, aren't based in LA. And so oftentimes we're seeing a lot of talent coming through those schools. And then I'd say the third is we do have a lot of inbound. And so oftentimes these inbounds from founders, maybe they've known some of the founders that we've worked with previously, oftentimes will get pitched. And so even with, I'd say for Darren, for example, from Mindset Care, which is our Fund 3 portfolio company, he pitched Peter while he was waiting for his Uber. And Peter said, well, I have X amount of time until my Uber arrives. And so I think from that perspective, the sourcing, I think, again, back to what we were talking about earlier with brand awareness, people are starting to know who Science is, some of our connected portfolio companies, some of our connected founders. And so we're so excited that the community is growing, and more we're finding partnership alignment. So that's been great.
Yeah, that goes back to our points earlier about having a strong platform.
Mhm.
And part of the reason that ARI has taken a long time, in my view, to deploy capital is because we've been building the platform. And so people have said, why don't you just go do deals? And my response has always been, I don't care about doing deals. Like, I've done deals in my whole life. That's easy. What's hard to do and what creates long-term sustainable value is building a world-class platform, because then it's working for you 24/7. When you've got brand and you've got connectivity and you've got visibility and you've got credibility,
Mhm.
now it's just a money machine. You put money in one end and it comes out the other, 2 to 3x bigger.
Totally, I agree. And I don't know if we've discussed this before, but I run this group called Senior Women in Private Equity, and it was founded with two of my co-founders in New York. And really, it was out of realizing, wow, we're not finding deals outside of anything in our workplace. And so the three of us started to get together, and it's grown. When I moved out to the West Coast and realized I wanted to build out my investment network there, we built out a West Coast chapter, and then now we're sitting at almost 4,000 women globally. And really, the idea is, how can we share deal flow in an informal basis or on an informal basis? And I think to your point, that's it. That's exactly it. Like, you are your network, and it's beautiful to see it grow. And it also brings in, to your point, like another diverse aspect to what our deal flow looks like.
Yeah, I was reading up on SWIPE, which is the
Right.
acronym, which very,
Yes.
very, very smart acronym. I like that. Very memorable. And I think you're so right. Having that network is what creates value. And, it's funny because people have often asked me, why do you have so many degrees? And why are you, in the CFA? Why do you have the CFA? Why do you have the CAIA, which is the CAIA for
Of
Chartered
course.
Alternative Investment Analyst? And my response has always been, well, A, I started out with no money, grew up with no money.
Mhm.
And so part of it's just, I don't ever want to be poor again. Right. And so you see that with a lot of athletes and a lot of successful business people actually who grew up with limited means. They're just relentless about getting better every day because they never want to go back. It's scarring. Growing up in poverty is very, very scarring. And I don't think there's any other way to put it. And I think almost everybody would agree. And so that's part of it. But now I don't need any more credentials, but I'm finishing up a doctorate at University of Florida. I don't know if I told you this.
Brad,
And
no.
people have asked me like, why are you getting a doctorate? Like that seems like a waste of your time. And my response has been, well, A, it's fun to learn, and I love being around smart professors and great classmates. So part of it's just I enjoy that environment.
Of
I
course.
like being around, smart people that are interested in business like I am.
Mm.
But a big part of it too is the network, because University of Florida has 500,000 plus alums, and
Wow.
they're super loyal. Like when I go to the gym at Gold's Gym in Venice and I wear a University of Florida hat, I get stopped by half a dozen people every single time. And they're like, go Gators, and and that
Yeah.
gives you the entry point to have a conversation, which is
Mhm.
all I need. You give me like an inch, I'm taking 3 yards, right? And so my thinking is not only can I become Dr. Ellison,
Mm.
right? But I can have a lot of fun doing it. And I can also now have access to a huge part of the market that's completely underserved, which is the Southeast United States, right?
Course. You've
And
opened the dialogue, you're relatable. I think that's super key and important. And I think again, it's relationships, like relationship building, right? We want to be able to relate and connect, and that's really how you drive meaningful businesses and relationships. So I think that's great. Congrats. I did not realize that.
Oh,
So
thanks. No, I mean it's a lot of fun. I'm just about done with all the classes and I'm doing my dissertation on venture debt. Surprise, surprise. And it's pretty cool because my advisor is actually the head of the finance faculty at the business school there at the Warrington
wonderful.
College of Business. And he did his PhD at University of Chicago, where I did my MBA. He did his
That makes sense.
PhD there in the 80s, and his advisor was Eugene Fama. So if you think about like modern portfolio theory and efficient
Mhm.
markets, that was all born at University of Chicago. And Eugene Fama is one of the most legendary investors out there, or certainly theorists around investing. And so it's pretty cool to have that Chicago and Florida lineage kind of like coming together.
Love that.
Yeah.
Really cool mind share.
So so shifting gears a little bit, what are some of the mistakes that you see VCs make? And where are some investments that maybe science got wrong and what did you learn from them?
That's gosh, very good question. I think oftentimes when we're working with these businesses, right, they're very early. And so I think for us, when we're thinking about, if I had to think about just broadly VC and where things get wrong, I think, again, what we saw with the FOMO deals a few years ago, I think that was, with us, we're very diligent on entry points. So we're generally 3.5 to 5 million pre-money. So some of these FOMO deals we couldn't get into. But in the end, right, I think some of the VCs did get burned, and that caused a shakeup in the market, and a lot of institutional capital went into that. And so I think, again, it just the positive side of that is that it improves underwriting processes now going forward across the board. I think for us at Science, oftentimes when we're looking at a business, maybe these businesses will seem like a venture-backed business as we're moving forward and we're working with them. Uh, but maybe in that studio time with the founder, we realized, you know what, maybe there's not a product market fit. maybe we're just not getting enough customers. And so that does happen where we've launched a business, we're working and iterating, but at that point, we want to make sure that we're not working with them to invest. And at the end of the day, that's where we're thinking about if something doesn't work. We're very open, honest, and transparent about that. And it kind of just goes back to values, right? Do you have integrity in these businesses, and to know what we know and to know what we don't want? And I think when the founders have that integrity, um, we will move forward. But when they don't, things, if anyone wants to hide information, if any, those types of things get uncovered in some way or another. And so I think for us, those would be not only red flags, but also reasons why a company would not continue to stay on.
It's interesting, as I've met with more and more founders over the years, it's made me better at raising capital for ARI as well, because it's kind of like sitting on the other side of the table. Like if you think back to when you were younger and you would be the interviewee and you go into
Oh,
some, can they be interviewing you,
yeah.
right? It always seemed very harrowing, and in hindsight, once you are on the other side of the table and you're doing the interviewing, you realize like, hey, this is pretty easy. Like all I want to hear is like some pretty simple answers and just stop talking, and
Yeah.
so I've learned that too, because when I'm dealing with portfolio companies or prospective portfolio companies, or even a couple of years ago before I was even close to deploying capital, I still learned a lot by evaluating others' pitches. And I thought, wow, like this pitch, for instance, a pitch that's very aggressive and exuberant,
Hmm.
sometimes like scares me off, because I think, well, they don't really have, they're not really in touch with reality, right? Like they're like, the TAM is $2 trillion and we're gonna revolutionize this world and be a $50 billion company. It's like, no, you're not, like with 99.99% probability. But if you came to me with something that was more realistic,
Hmm.
like that's actually more compelling. And so I think a lot of the things I've learned has have come from seeing what founders do wrong in their pitches. And a couple of things I've learned is, to your point, be authentic. I mean, I think that helps quite a bit. Is just be yourself, and I always have been. So that's easy. Have high integrity. Don't hide things. Just tell people like, hey, this is where we're struggling. Like, this is going well. This is what's not going well. This is where we need your help. Right. Obviously, you put a positive spin on it. You're not gonna,
Sure, sure.
it's like dating, right? You want to be honest with your partner or potential partners, but you also don't want to tell them all your negative aspects, on day one. So it's kind of, yeah, actually, I think dating is a great analogy for raising capital, right? It really is like that.
Yeah,
But,
sure.
um, but yeah, I think, founders who are authentic, have high integrity, are just very transparent. I think that goes a long way, and it especially goes a long way in today's market, because a lot of founders are, I think they're feeling pressured to say things are better than they are, because they know things are not going well and their valuations have cratered and their growth is slowing and their employees are leaving and they're worried. And so they try to put on this facade,
Yeah.
right? And any good VC can see through that in about 2 minutes. So what would be more compelling is if they were just honest and they said, here's where we think we really can still make a big impact,
Mhm.
but we've got these problems, right? One of them might be liquidity or valuation, and we need to fix those. And we would love your help, because if you help us, here's how we think we can add value for you and deliver performance.
Exactly. That is so key. That that certainly is resonating and something we've seen.
Have you seen any companies recently that you feel, I mean, obviously don't name them, but do you feel like there is a trend towards kind of hiding the ball, so to speak?
I've seen a couple, yes. I think um, there's maybe again, it goes back to that psychological shift of, um, and especially I think at the earliest stages, really wanting to make it work, right? And I think we've just worked with so many founders now that we know, and at the end of the day, we're really looking for, the support behind it. And I think that's one. And the second too is when we start to see companies that may want to start fundraising earlier than we think they should. And so I think for us, it's, do they need to fundraise now? Are there other ways that won't dilute the cap table for all of us, right? For many reasons. And so we always suggest, don't just raise just to raise. Don't just try to make a business work if it's not working. I think, again, it just goes back to what we just said, right? It's how do we just have an open dialogue on things that are happening in the business? And I think that just ultimately goes back to what our platform is, right? Can we have visibility into the data that we're used to seeing? We have high fidelity data and access from the very beginning. And if you don't have that, I think that just breaks the trust. And once the trust is broken, it's really difficult to get back.
You mentioned not diluting the cap table as being important, and that kind of leads us back to venture debt, in the sense that debt is not dilutive at all. The equity warrants that come with venture debt are somewhat dilutive, but a lot less so than straight equity. So how do you think about debt as a solution for founders? And also, how do venture lenders work best with venture equity investors?
Sure. I think it's a supportive financing tool, and I think everybody really should look at it as an option. I think at the end of the day, again, there are so many different types of businesses, and each business has its own different capital needs and structures. And so we've thought about even some of our companies, right? And if we're thinking about consumer inventory, right? Consumer inventory is a big one where it's expensive, it's hefty. We've also thought about others that are working on ad spend, right? So maybe that ad spend is not, necessarily well spent through equity dollars. So if you think about just how do we maximize the value on our cap table, how do we maximize the business? I think at the end of the day, yes, I think there are options. I think you had mentioned equity warrants as well. I think that's an attractive one that I don't think many people know about. So I think that would be a dialogue that should be talked about a lot more. I think venture debt as an option, especially again, going back to before they start raising, we don't know what we don't know. And so I think it comes back to educational awareness. And that's something that, at our studio level, we're starting to come up with a number of different resources. We have landing pages that founders can now access and get educated. We start to have community engagement events where we bring in groups like yourself, right? Can you talk one-on-one with our companies and just be in the same room? Because at the end of the day, it's to your point of, maybe you're not pushing the product now, maybe it's not in need right now, but at least you're remaining top of mind. So I think oftentimes it's like, maybe we don't need it now, but at some point, if they come across, if they're in a position where they require it, maybe then they're thinking, oh, who do I now know? Who can I go back to? And again, it goes back to having access, resources, and the knowledge. So that's.
I agree that the sales cycle is long, and it should be. I think it's not always long. Sometimes it can be you meet somebody and you're funding them 4 weeks later.
Yeah.
But the reality is, if you want to really form that relationship and build that relationship on education, right, and eventually trust and credibility, that takes time. It doesn't happen overnight. And so, a lot of the best deals were sown 3 to 5 years beforehand.
Mm-hmm. Yeah, what I like about it too is like, if we go back to the warrants aspect. So I think you still think about that long-term relationship with the groups, right? So if you're a venture debt and it converts, at some point into equity, it's like, wow, we've been a partner and supportive along the way, and so you've known the business, maybe at an earlier stage. So I think that's great. I agree.
Yeah, I want to dive into that just a little bit in terms of the warrants, because what I think warrants do, and actually I'm going to take a half step back. For folks that don't know, a warrant is basically a call option, which is the right to buy shares in the company that you've lent to.
Mm-hmm.
So most venture debt deals, will consist of a loan, typically 3 to 4 year loan, and it'll have a mid-teens type interest rate. And then in addition to that, the lender also has this option to buy shares in the company. And usually the warrants have a 10-year expiry. So the lender can buy shares in that company at any point over the next 10 years. And ostensibly, they're going to exercise those options if the company exits and they're either acquired or they go public, right? And so that's what's nice about this, what people don't often realize, it's super elegant in its structure, right? Because it's not just about the lender potentially having more upside, it's about long-term alignment. And this is what people miss. If I'm a lender and I've got a 10-year option to buy stock in your company, I am going to be rooting for you and supporting you even after the loan has matured. The loan can mature in 3 years, but I've got 7 more years after that where I'm still aligned with you because I've got this ability to generate a lot of upside if you do really well. And if we didn't have those warrants, then the incentives wouldn't be aligned because the lender would be thinking, I just want to get all my money back within 3 years, and I don't care what happens to that company after 3 years. They could fail 3 years and 1 day from now, and I wouldn't care if I didn't have equity warrants, right? That's what the lenders are thinking. And so that's why venture debt to me is such a interesting product from an academic perspective as well, and which is why academics call me all the time to want to partner on research, because it's got this incentive structure that's completely different from a straight term loan, right? And it's also got components that are completely different from straight equity. So it's this hybrid product. And there's so many different things that go into that make it really interesting from a research perspective, not to mention that there just hasn't really been that much work done on it previously because it hasn't been that big a part of the market. It's emerging still, right? It's growing fast, but it's it's a relatively small segment of the market still. And so there's just so much opportunity there, I think, on the research side, which is, when I put on my academic hat, I get excited about it because there's some really interesting theoretical implications. And one of them, probably the most important in my view, is this idea of alignment, right? So anyhow, so switching gears again, we don't have much time left. We've got about 10 minutes. I wanted to talk a little bit about AI because everybody's talking about it, and I would love to know how you're thinking about it, how science is thinking about it, and just generally how you think it's going to impact the world and the VC ecosystem.
Yeah, I mean, all of our companies and our entire team, including myself, I mean, I'm playing around with AI every day. So, and that could be, I mean, at the most limited capacity of, setting up an itinerary for a trip. I mean, that's, how simple is that? But I think on a larger scale and more impactful, I would start with, sure, there's generative AI. There's also many tools. How can we find ways to make things more efficient? So when I was speaking a little bit about our Fund 3 company, Mindset Care, and actually does utilize AI, and what it's doing is turbo taxing that process to apply for Social Security and disability benefits. And what that means is, how can we quickly upload information and have it spit out really, really smart data for us, and understand and fill out certain assessments, and making sure that we're filling things out appropriately to meet regulatory guidelines. I think that's going to make a massive difference across government tech, and which is, again, a very archaic system at the moment. And so I think when we think about our businesses of, what are some of these legacy businesses, large conglomerates, maybe legacy processes, how can we make those more efficient utilizing AI? So that's, I mean, I'd say Mindset Care is probably at the forefront of that. We do have another company called FIY.ai, and that stands for Fix It Yourself .ai. And they're working on something really interesting where they work with a handful of, let's say, OEMs, manufacturing companies, and ingesting those manuals and really making it quite smart to essentially be that customer service troubleshoot on behalf of the corporates. And that's meaningful because how often, if let's say we have, I don't know, maybe you have a vintage car, and where are those manuals? How do you know what part do we need to fix it? And maybe you have to find a foreign auto center to find a piece that maybe you're like, oftentimes it's really difficult. So I think it's making our life easier, which is at the core of everything that we've always wanted to do, in a very shortened amount of time. So I think for us, AI is going to be something that we use across all of our businesses. Another company that's more on the media space is called Typo, Typpo, and it's utilizing AI by voice diction to create presentations. And that is super cool because we're now seeing a lot of conglomerates like a P&G, for example, who are thinking about innovation in new ways, and they have a handful of different brands and products, and how are they able to innovate quickly? How can they utilize some of these programs like a Typo to spin up a presentation, to spin up graphics, to spin up things just much more quickly than we ever have before? So that again is just more relating to our portfolio and our company, but I think just broadly what we're seeing across the board, AI is going to be here for the long run, and it's only getting smarter and faster.
So one of the things I worry about with AI is that in the short run, it'll make us a lot more productive, and everybody using it will essentially be more efficient, right, with their time and energy. But over time, of course, that could mean that some jobs are not necessary anymore, and people actually lose their job. So that's one thing I've been thinking about. That's fairly obvious. The other thing I've been thinking about is how AI will make us more efficient in the near term, but inherently it will make us lazier because we'll be using it for things that we used to have to use our brain or our body to do. And so we'll essentially become detrained, we'll atrophy essentially, right? Like our brains and our bodies, when AI continues to advance, will have a inverse correlation with that. Like our advancement as humans, like our ability to apply real intelligence, ARI, which is why I named it that essentially, is going to decrease. We're gonna become, we could potentially, not necessarily, but we could become, lazy slobs that sit around and think that AI is going to solve everything for us, and robots and technology are going to do the rest. I mean, what's your view on that? Do you think we're at risk of becoming
Obsolete?
yeah,
No.
obsolete and lazy slobs?
No, if anything, I think it's become it's quite a bit of work to actually, I mean, if you're in ChatGPT or Bard or any of these platforms, I mean, you really have to think about how to be smart and how to prompt it. So I think it's just, how do we ask better questions? How do we, and at the end of the day, that's true. It's like, how do we make sure that we're producing the right discovery options and path forward? So I think for us, it's, or at least for me, how I think about it, it's okay, understanding what my end goal is, but how can I use ChatGPT to make a process better? I think there are going to be certain elements where, yes, maybe we can utilize, it'll decrease maybe the work productivity, from a human capital perspective, but I think it's also going to open up other opportunities for us. I think there's going to be many more people who are going to think about other advancements in technology. I think there's going to be a lot of personalization around utilizing AI. I think there's going to be adaptations. There's going to be, again, I talk about like discovery. So it's like, how can you enhance what that journey looks like? And that again, only makes you smarter by being involved in AI. So that's how I'm thinking about it. But
Yeah, no, that makes sense. It's funny because AI prompting is becoming an art form in a sense, right? And so you're still using your brain because now you're thinking, how do I actually prompt Chat GPT, for instance, to give me the results that I want? There was an article out recently about I can't recall who published it, but it was about how with the right prompting, you can actually get Chat GPT to give you answers to things that should be banned, like how to make a bomb or how to do something illegal. Because if you prompt it, it'll eventually break. Like there's like a backdoor way into getting the information that you want, even if you're not allowed to get that information on the surface, you can kind of dig in and trick the machine essentially. So I thought that was very interesting, and it goes to show that there's still a lot more that needs to be done. And I think there's a lot of risk there that.
yeah, I think that's, I mean, at high level, yes, there are still risks. And I think it's just having the oversight around making sure that we have restrictions in place. So that's scary. That's a scary, dark place of AI.
Yeah, I mean, I think generally most people are thinking about the positive aspects, but we do need to keep in mind all the negative potential aspects as well.
Yeah, that's
So,
true.
last question of the day to leave everybody with. What are the key themes that you're thinking about over the next couple of years outside of AI? Anything that you think is relevant that folks should be thinking about?
Yeah, I think when again, it's really through the lens of consumer and these cultural shifts, right? We talked about how's the current generation, how are they spending their time, their money, their energy? And I think for us, and a different angle that I've seen are actually through a lot of the federal budgets. If you think through what is the government spending on, what's driving them, I think has also been an interesting angle, at least for me and for my team, in thinking through, okay, federal budget is actually being spent in many states on mental health. And what does that mean? And when they say mental health, when you start to dig in, going into the states, the municipalities, that's really driven us to really go deeper into mindset care. So when we think, I think mental health is a big area for us. I think better for you health. So areas, certain states are trying to fight obesity. How do we find, right? We saw the Ozempic, this pendulum shift, right? I think there's continuing to find alternative medicines. So outside of just our general healthcare, PCPs, how do we find those that really tackle certain chronic issues that maybe on the face of it we can't see? And I think the third is really just, if I think about it again from a value shift, it's these wellness, the experiences, and how we think about our bodies. There's a lot of talk about the biohacking and climate. And I think all of those, in a sense, are kind of bucketed under what are our values today. And then the second pillar I'd say is, where are those federal budgets being spent? So from more of a macroeconomic view, but that's how we're generally thinking. Again, we're trying to see around the corner and what's next, and I'm really excited to see what we're going to build in the next couple of years.
Yeah, I'm excited to see what you guys are going to invest in because you're investing earlier than I am. And so I get to see
Yeah,
what you
we'll get
guys
you
are doing
involved.
and then ride off the success of your investments.
Well, we're going to partner on those, so I can't wait.
Yeah, yeah, I'm excited. And it's been really nice having you on, Priscilla. Thanks for joining today.
Thanks for having me. So good to see you.
Likewise. And thanks everybody for listening to the 7 and 7 show. See you next time.